Good morning. It's Monday, the 15th of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai. The take for today: for several years, the biggest symptom of the government's failure to get out of the business of doing business was Air India. And then the government realized that the losses had piled up so high that it was just not worth it. Of course, that decision could have been taken any time in the last 20 years, but then better late than never. So one fine day in January 2022, or 2.5 years ago, the government successfully sold Air India to the Tatas, who knew then and now that they were buying a giant migraine which would stay with them for the foreseeable future, as migraines are wont to. The expectation from the current dispensation was, in the early days perhaps, was that they will move away from the traditional socialistic pattern of controlling or running businesses and hand over increasingly to the private sector. Now, that is not, and as the core report has been consistently pointing out, will not happen in our near future. The fact that stocks of state-owned companies like public sector units are doing extremely well in the stock markets, though in many cases for reasons some of the best market analysts cannot quite fathom, is obviously emboldening the government to stay the path of being a business manager in addition to managing the economy and then everything else. Reuters is now reporting that the government now plans to overhaul more than 200 state-run firms to make them more profitable. This, not surprisingly, is a departure from Prime Minister Narendra Modi's aggressive program that has struggled to take off, according to government sources. The program was to privatize a major portion of India's $600 billion state sector, announced in 2021, had slowed ahead of the general elections in April-May, and could face more resistance, that is the feeling, though I feel that is not so likely, or there is very little connection between the government's condition or its coalition and the desire to actually sell those assets. The new plans apparently include selling large parcels of unutilized or underutilized land owned by these public sector companies and monetization of other assets, officials who are not supposed to be quoted told Reuters. The aim is to raise about $24 billion in the current April to March fiscal year and reinvest the funds in the companies while setting 5-year performance and production targets for each company instead of short-term targets. One of those sources said that the government is shifting focus from indiscriminate asset sales to enhancing intrinsic value of state-owned companies. Translated, the government is digging its heels in and staying put. Or, put differently, it will continue to manage the economy and businesses in it. Reuters also quoted Hardeep Puri, India's oil minister, saying last week that a plan to sell state-owned Bharat Petroleum Corporation, or BPCL as it's called, was no longer on the table as the company was making almost as much profit in a year as the price it was to be sold for. Governments in India don't like to let go of public sector or state-owned corporations. For one, they make lots of money, particularly if they are in a monopoly or close to monopoly area like energy or defense. Now, the money itself is something to lean back on for a rainy day or every other day in the form of dividends that enrich the exchequer. It can, of course, be argued that divesting at such high prices in the stock markets is also a good idea, but then that would mean giving up control. Owning assets also imparts a sense of power and access, which the government in general has lost over the decades with the increasing role of the private sector. We're now seeing an effective rebalancing of an old equation. And this could also provide an outlet for job creation, for example. Remember, state-owned oil corporations have in the past, let's say, awarded petrol pump licenses or other licenses for gas distribution. Now, all of this, of course, has limitations, but then you can't argue when share prices are high. Maybe the government is doing something right, just maybe. It does go against the grain of effective allocation of resources and, of course, time and energy. And where the government of the day should be focusing its energies on for the betterment of its citizens' aspirations and lives, if not livelihoods. Remember, each of these sectors are attached to ministries, and then ministries have ministers, and then, as you know, the story goes on. And now a look at the top stories and themes for the day. The stock markets are on a holding pattern, but earnings are in spotlight. India is losing battle with food prices as food inflation now touches close to 30%. New taxes to discourage companies from moving headquarters around the world are coming. And Lufthansa says high prices are causing business travel to shrink, and American carriers too are reporting tougher times despite stronger traffic.
This is the Core Report with Govindraj Ethiraj.
The stock markets are at a holding pattern now. So the markets had a good week last week, but the coming week is a holiday shortened one with a holiday on Wednesday for Muharram. Much as I love doing this show, the occasional midweek holiday is a welcome gift, I must confess. So last week, the broader indices continued to run strong but ended on flat and underperformed the main indices in the week ended July 12th. The BSE Sensex was up about 523 points to finish at 80,519, so above 80,000, while the Nifty 50 was up about 178 points to end at 24,502. On Friday, that's the 12th of July, the Sensex and the Nifty touched record highs of 80,893 and 24,592. So the top performing sectors last week were information technology services, where we seem to be seeing a resurgence of sorts in some sense, or at least a general return of capital and interest, and particularly institutional capital flows, even though the results, which is the performance, has been somewhat predictably weak. Oil and gas did well last week, though bank, realty, and auto fell somewhat. This week will be an interesting one because first quarter, which is April to June 30 results, will coming out in greater strength. We saw, for example, last week companies like TCS and HCL Tech release their results. Analysts we've spoken to in the last week are expecting consistent growth and have not seen any major causes of worry in the first quarter, which could have affected corporate results badly or affected them, except some bumps here and there, maybe in consumer-facing companies, thanks in turn to weather patterns and uneven consumption. For example, auto companies say that they saw slowdowns because of lower arrivals or visitors at dealerships. Reliance Industries, Bajaj Auto, BPCL, Asian Paints, and Infosys are amongst the companies who will announce their results this week. On Friday, HCL Tech announced a 20% increase in consolidated net profit to 4,257 crores for the June-ended quarter and said that its revenue would grow anywhere between 3 to 5% this year, thanks to Gen AI diversification and strong execution, according to LiveMint. HCL Tech also interestingly reported a lower headcount, which means high attrition compared to, let's say, TCS, which had actually said that headcount had gone up in that quarter. Inflation rises and food inflation's vice-like grip. Retail inflation for the month of June rose to a 4-month high of about 5.08% after food inflation jumped to over 9%, the highest in 6 months, according to data from the National Statistical Office, or NSO, that was released on Friday evening. So the big problem is food prices, which represent almost 40% of the consumer price inflation basket. So inflation rose after falling for about 5 months, and the reason for food price rise is, of course, extended heat wave episodes across major parts of the country. Vegetable inflation is now close to 30% in June and has remained in double digits, as we've been pointing out, for about 8 months now, and we'll address that in a moment. Food inflation, based on the CPI, or Consumer Food Price Index, rose about 9.3% compared to about 8.7% in the previous month, and again another 8.7% approximately in April. So the higher food inflation in June was because of rises in prices of items such as cereals, vegetables, milk, and milk products. So the big questions are, will food inflation cool down now that the monsoons are gathering steam? And more importantly, what are the short and longer term issues at play when it comes to food prices? Because, as I ask, food prices are not just a mild statistic to ponder over, but something that affects our daily lives. I reached out to Crisil Ratings chief economist D K Joshi, and I began by asking him how he was seeing the inflation numbers, also in the context of, as he termed it, stubborn inflation in food, a theme that his team and he have been focusing on and spotlighting for some time now.
First of all, vegetables have a very high weight in our consumer basket. It's 40%. The worry is that without bringing food inflation down, I think you cannot get to the target of 4%. So that is, I think, from the monetary policy side. But why food inflation has remained high? If I just focus on the month of June, why did food inflation go up to 9.4%? I think if you see, June was the hottest month in recorded history for northwestern India. And on top of that, in general, the rain was about 11% deficient. So there was a unpredictable weather which hit particularly the more perishable commodity like vegetables. So vegetable inflation went up. But in general, I think what we have been seeing is that heat waves do impact production. They also deplete the groundwater levels. And I think we've seen in the past that the wheat grains get shriveled if there is a heat wave. And also pest infestations typically rise when the temperature rises. It's not only food grains, it's not only vegetables, but it's also dairy and poultry output that sometimes get impacted because of inclement weather. And also, I think the unseasonal rains, which we have seen in the past, they can hit crops during harvesting and even during the transportation stages. Clearly, when you have inadequate storage, when you have lack of food processing, you have low ability to forecast, I think, in general, output and prices. And the productivity in agriculture is also low. So I think all this points towards your more vulnerability to climate related shocks. Earlier, it used to be just the rains, I think, but now the scenario has got complicated with the dimension of climate coming in.
So we've been running at over 20% even before the rains. I mean, rain started, let's say, first week of June and then spread to the rest of the country. But we were seeing high food inflation, particularly vegetable price inflation, even before that. So it's only now that it's gone up even further.
That's true. And the reason is because these shocks don't happen at one time. Sometimes it's the heat wave, sometimes it is the excess rains, sometimes it is something else, sometimes it is pest. A variety of shocks have been hitting agriculture, and the more vulnerable component is vegetables. So that's why vegetables inflation hasn't come down. I think it has remained quite high.
So let me ask you slightly more, let's say, abstract question for lack of any other term. In any normal household, so I mean, what we are saying is food is 40% of the consumer price inflation basket. If food were, let's say, lower, then maybe overall inflation impact would be low. But what does a typical family in a country like India really feel? Where does it hurt the most?
Food inflation hits the poor most because if you look at the consumption basket of the poor people, the share of food is much higher. And that is why I think our assessment shows that bottom 20% of the population in both urban and rural areas currently face about 40 to 50 basis point higher inflation than the top 20%. And it will vary depending on which category you pick up. I mean, so the poor get impacted more by high food inflation.
Right. So even if inflation were to go down from where we are today, and when we look at some of the key vegetables like tomatoes, onions, potatoes, that's the top, and so many other vegetables, prices are going to remain high. What is it that we can do or should be doing as a country in interim or medium term? Long term is, of course, very long term to address it or try and address it.
Well, I think first of all, we have budget coming up. So the first question that comes to mind is because this problem can be addressed through fiscal measures, not through monetary measures. RBI's rate hikes are not going to bring down food inflation. So you need, I think, more adaptation measures to climate change, I think, which means more early warning systems. You need more weather resistant crops. You need to engage more with farmers to sensitize them on changing climate. And we've seen, I think, some progress in terms of getting the heat resistant wheat, which is a welcome step, I think, but you need to do much more than that. Then I think second thing you need to do is you need to upgrade the infrastructure in agriculture, whether it is in production to transportation and even, I think, storage. I think that will ensure that the loss is less and I think the wastage is reduced. That is also like improving the supply. One thing which comes to my mind is very important, I think, is that the farmers do require some kind of guidance on or some kind of signal on prices. The only signal we have is the minimum support price, and not for all crops and not in all regions. I mean, it is only mostly in the north and the west, I think, where farmers benefit from that signal. Even for other crops and even for vegetables, for instance, I think there can be some price improvement in some forecasting techniques. The statistics shows that whenever the vegetable inflation goes up, farmers sow more of that and then vegetable inflation drops. So I think there should be some way to guide them not to rush into this nexus of producing more and I think then suffering because of a crash in prices. So I think better forecasting technique, we need to invest. Then I think we need more food processing, as has always been said. I think less than 5% of tomato in India is processed. And I think tomato is the one that saw almost 250% by inflation, I think, few months back for a very brief period, though. And then I think the overall, from a very long-term perspective, you need to improve productivity in agriculture. If I compare India and China, we have almost similar arable land. But China produces almost twice as much agriculture output than we do. So which means that they are producing more per unit of land. And currently, I think we are making efforts at improving productivity, but you need to move much faster. And also, I think, improve the R&D expenditure that happens in agriculture. So I think these are some of the things which could be done to address these issues. And some of them will have immediate effect. Some of them will take time to have an effect. But we need to work much faster on this because this is a very important issue, not only from the perspective of farmers, but also from the perspective of consumers And finally, also from the perspective of monetary policy, because in an inflation targeting country, I think you need to have inflation at 4% on a durable basis, which the central government has been saying. And that cannot be achieved without low food inflation. The only time, I think, in the last 24, 25 years, we saw food inflation come down and bring down the overall inflation to below 4% was somewhere between 2000 to 2006, when average inflation was 3.9%, but food inflation was only 2.5%. So without bringing food inflation down on a durable basis, it is very difficult to bring the overall inflation down to 4% on a durable basis.
So if you look at, let's say, the role of the government and the role of private sector in resolving some of these aspects of, let's say, the entire agricultural supply chain, where do you feel at this point of time, where we are right now, and who could be playing a greater role at this point of time?
I think government will have to play a greater role at this time because they can take measures to bring food inflation down quickly. And even I think many of the structural measures will require government to step in, and they'll have to incentivize, for instance, food processing so that it happens at a much faster rate. And even credit to food FPOs, as they are called. I think that also many of them, farmer producer organizations, they face difficulty in getting credit. So some sort of mechanism for ensuring that proper assessment is done and credit is given. So there are many things that can be done, but the government will have a role in that. And if there is an enabling environment, then private sector also can step in, I think, over a period of time.
Right. DK, thank you so much for joining me.
Thank you, Govind.
Direct taxes are up. So tax collections, particularly direct taxes, have now up 20% from a year earlier to about 5.74 lakh crores or 574,000 crores in this year so far, thanks to a jump in personal income tax flows, says the Economic Times. Personal income tax collection is seen rising further because some individuals are expected to pay taxes with returns for 23-24. That's the last financial year. The last date for filing income tax returns, and do note, is July 31st, which is in about 15 days from now. That's for the assessment year 24-25, which means for last year. The reason for rising tax collections is corporate profits, which are, of course, rising, says the Economic Times. Strong profits, of course, augur well for Q1 results, which we just referred to, and thus the markets in the near to medium term before other factors take over. Net corporate tax collection for the fiscal as of July 11th was up 12.5%, and net personal income tax collection was up 21% to about 3.5 lakh crores, according to that data released on Saturday as per the Economic Times. If you like what you are listening to and would like to collaborate with us at The Core Report, here's some good news. We are happy to announce the launch of the Core Brand Studio. Write into my colleague Shiva Chaudhary at shiva@thecore.in. I repeat, Shiva, that's SHIVA, at thecore, THECORE.in for more information. What are the big corporate tax issues? So one big expectation from the Union Budget on July 23rd is that India could announce the adoption of Pillar 2 tax regime anchored by the Organization of Economic Cooperation and Development, or OECD. Now, this is part of a larger global effort to fight tax avoidance. The basic idea is that multinational enterprises, also called MNEs, should pay a global minimum tax, which will or then should discourage profit shifting. For instance, you may have noticed several US multinationals have domiciles in Netherlands or Ireland. So the minimum effective tax rate, or ETR, of 15% is what is being targeted across all jurisdictions in which they operate. So who are these MNEs? Well, MNEs are defined as those entities with a global turnover over 750 million euros. So to understand this a little better and also get a sense on what some of the key corporate tax issues Indian companies are facing and focused on ahead of the Union Budget, I reached out to Dwarak Narasimhan, partner at Price Waterhouse Co LLP in Bangalore, and I began by asking him to first take us through the new second pillar developments.
So international tax, I think there are 3 or 4 very critical items that the government could possibly consider. Of course, what is top of the mind for everyone is Pillar 2. Pillar 2, as we know, is the broad global agreement to move towards a global minimum tax rate of about 15%. Several countries have already adopted rules. India has not yet come out with rules. There is a huge expectation that in this budget, the government will frame rules for the adoption of Pillar 2. The reason that is critical is A, of course, preparation is important. Two, it is heavily data based, and therefore companies will have to ensure that their systems are up to speed. They're able to extract all the data they need from across the world and ensure the appropriate filings and computations are done. The second aspect linked to this is the significant economic presence. Now, this is a provision which was introduced in law a couple of years back, along with the digital services tax called the equalization levy. The way the SEP works is that under domestic law, it deems a foreign company to have a business connection in India, assuming certain thresholds are met. Now, those thresholds are de minimis. And there has been a huge cry. One, they're de minimis. Second, they're extremely broad in their ambit. They even cover aspects such as the sale of goods in India. So there has been a cry from industry saying, please clarify, A, the threshold, increase the threshold, make it more relevant to companies. And second, please exclude certain things like sale of goods, because that was never really the intent with which such a provision should have been enacted. So that's the second big thing that the government should look at. The third one is really more of a wish. I would say it's not really something that's on the government's radar, but this whole concept of permanent establishment. And it's picked up a lot of steam more recently for two reasons. One is cross-border travel of senior personnel has rebounded post-COVID. And also with the huge increase in the number of GCCs being set up in India, we are seeing a lot of travel expats coming back to India. So that oftentimes triggers a permanent establishment issue. There's also the indirect tax ruling in the case of Northern Operating Systems, which has brought this whole people movement up to the front. And the second aspect has to do with this whole concept of a virtual PE or a digital PE, right? Now, this is again extremely nascent. There are no rules anywhere in the world. But in what circumstances, especially in a world which is increasingly digital, where a lot of the decisions are being taken through technology, through the presence of servers in India or through algorithms which might run on a server in India, right? In what situation can that constitute a permanent establishment? So the third one, as I said, on the PE is really a bit of a wish list, I would say. I am not sure that the government would clarify it upfront, and there is limited guidance on aspects such as virtual PE in the world. But from an international tax standpoint, I think these are the three main areas.
Right. Okay. So I'm guessing that in terms of anticipated impact, the pillar 2 or the minimum tax rate is the most observed or being most watched out for right now. So who are the companies who are most likely affected by this at this point? Assuming, let's say, something happens on the 23rd of July.
Two parts to that question, right, Govind? The first is, of course, Indian companies, large Indian companies who meet the threshold of 750 million euros in terms of their revenue in the prescribed manner, are the ones that are immediately going to be impacted. Now, for these companies, it's going to be important for them to follow certain computation mechanisms to determine whether they meet or do not meet the global minimum tax rate of 15%. Now, there are various intricacies in this. There are rules in different countries. There are provisions in different countries with regard to how you might compute that global minimum tax rate. What can you aggregate? What do you not aggregate? For example, if you have multiple entities in a particular country, out of which some of them might be benefiting from a lower tax rate or some sort of an exemption, or even may not be operational, that brings down the effective tax rate, right? So some of those intricacies become important. And then obviously, how does India frame its rules in terms of the mop-up? So let's assume you're in a situation where after doing the computations, the global minimum tax rate comes to 12%. The remaining 3% to make it whole, so to speak, to 15%, how is the government going to frame those rules? Now, again, there is a certain hierarchy, if you will, which governments have the freedom to follow, subject to them bringing it into their regulations, right? So how is the Indian government going to enact it? Are they going to say that we have the first right to impose that top-up tax? Are they going to give that first right to that country first to make it right, and then to bring it to a certain corporate tax rate, and thereafter take the differential? So those are some of the aspects that will be clarified. The immediate impact is for large Indian companies. However, I would also say large global multinationals who meet this threshold, it could be a US corporation, Japanese corporation, anything else, all of those companies will have to comply with these rules in their country of origin to the extent the rules have been enacted. And there are about 35 to 40 countries which have already enacted those rules, right? Japan is one of them. How do the rules in India then interplay with those rules? So in the reverse situation, for example, do they have the ability to have a top-up tax, or does India have the right to make them whole, etc., etc.? So those are some of the finer points we're hoping the rules will clarify.
Would this in some ways run parallel to a double taxation avoidance agreement in terms of the way it's administered and the net off is done, or is it a parallel effort?
Fantastic question, Govind. There's a lot of history to this, right? This whole process started off in 2014, right? So it's taken 10 years to come to this point. In fact, when the OECD first conceptualized this to start off with the G20 and then increased to 99 countries and 150 countries, etc., they said, what is the problem we're facing in the world today? The problem we're facing in the world today is that companies are avoiding taxes through cute structures, right, in Ireland, etc., etc. So we want to close these loopholes. They came out with 15 action plans. There was agreement on 14 of them across the globe. There was no agreement on one, which was action plan 1. That action plan 1 then morphed into something else. It morphed into pillar 1 and pillar 2. Pillar 1 being the digital tax, the equalization levies, etc. Pillar 2 being the global minimum taxation, right? Now, the way this has to be enacted is through a combination of rules which will come into effect in different countries, such as the ones that we're talking about, and under the broader framework which has been agreed by a number of countries which have signed into this arrangement. So it's going to be a combination of those.
Got it. Okay, last question. So if at this point, if you think of, let's say, your top clients, what is on their minds in terms of, let's say, the bigger corporate tax issues that are weighing either in the way they present their balance sheets or the impact that they're seeing, whether in India, if it's a India only company or if it's a global multinational, either from India or from overseas in India? What are the 2 or 3 top things on their minds?
Sure. So, Gaurav, I'm just going to say probably 3 points, right? 3 points. 1, tax litigation continues to be a concern. The amount of money which is stuck in litigation and the amount of time it takes to achieve certainty in India continues to be worrisome. We've moved towards a board for advanced rulings a couple of years back. That's still been in limbo. Cases are not being decided at the speed they would. That is an appealable order today under the regime. And therefore, investors are worried about certainty with regard to taxes and the timeline it takes for litigation. First thing. Second, there is a hope that there will be some sort of an incentive given to manufacturing. There was the reduced tax rate of 15%. That has now expired. The hope is that, hey, can we look at a 15% rate for a longer period of time, whatever controls you want to put in, but give us a period of time, because manufacturing is not something that I can just decide today and start tomorrow. There is gestation period to set something up. So that's, again, the second big expectation. The third one is a slightly nuanced one, which a lot of foreign companies will face. More and more, we are seeing payments go from India subject to withholding tax, royalties, fees for included services, etc., etc. The authorities are beginning to look into aspects such as beneficial ownership, such as, is this a tax avoidance arrangement, and so on and so forth. Some clarity with regard to how that's going to be administered would also be helpful. Right? But I think these are sort of the 3 broad themes: the litigation, the manufacturing, and some part of international tax, ease of doing business. How will the company come across to foreign investors?
Got it, Dwarak. Thank you so much for joining me.
You're welcome. Thanks for your time.
Lufthansa cuts back. Well, it's not clear whether other airlines in Asia and Middle East are facing similar pressures, at least yet. But German airline Lufthansa has said it will slash costs and cut back on future projects as a new reality of lower corporate travel and increased competition drives down fares from post-pandemic highs, according to a letter to staff seen and reported by Bloomberg. The carrier said while its costs have risen sharply, unit revenue has been lower than expected as customers aren't prepared to pay higher fares, according to that letter. With corporate travelers in short supply, the airline isn't able to compensate for seasonal demand fluctuations, the airline said. We are experiencing a new reality, not a crisis, but a structural change, the airline CEO wrote in a letter seen by Bloomberg, adding that after 2 years of soaring demand, we are seeing a normalization in the market, which is accompanied by high competitive pressures. Bloomberg also says, by the way, that across Europe and the United States, airlines are struggling to fill planes in the all-important summer vacation season, which has dragged down ticket prices. On Thursday, Delta Airlines warned of worse-than-expected financial results and a weak outlook for the third quarter. The airline, that's Lufthansa, expects business travel to remain at its current low level and to see more leisure travelers visiting friends and relatives or going on vacation. As a result, travel is skewed towards the summer instead of the winter, according to them. So the question, of course, is how Asian and Middle Eastern airlines are seeing their traffic patterns and, of course, revenue. We will update you on that in coming days. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.